Welcome to the Turnaround Podcast with your host, Stephen Phillips. In each episode, Stephen speaks to experienced practitioners who discuss their careers, key moments, challenges, and lessons learned in financial turnarounds and business restructuring. Join us as we unravel the secrets to turning struggling businesses into success stories. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, frylibertas.com. Now, here's the host of the Turnaround Podcast, Stephen Phillips.
Today, we welcome Zip Jila, partner at Warwick Capital Partners. Warwick was founded in 2010 and is a global investment firm. Its original special situations strategy focuses on addressing complex capital needs across both debt and equity for European mid-market companies. I've had a number of episodes focusing on advisors in the restructuring industry, and am delighted now to be talking to somebody who has skin in the game with a principal's perspective. Zip has been with Warwick for 6 years, where she has played a pivotal role in the investment team, focusing on private equity and special situations. Before joining Warwick, Zip honed her expertise as a private practice lawyer at Aiken Gump, formerly Bingham McCutcheon, and Hogan Lovells. Her dedication and impactful contributions to the field have not gone unnoticed. She has been recognized by Global Restructuring Review as one of the 40 under 40 rising stars in restructuring worldwide. She is a thought leader in her field and had 2 terms as a member of the Insolvency Rules Committee, which consults on any changes to insolvency rules here in the UK. We're thrilled to have her here today to share her insights and experiences with us. Zip, welcome to the Turnaround Podcast.
Thank you for having me, Stephen.
Well, I tend to start every episode with your background history. Can you tell us how you found yourself in the restructuring world or the special situations world?
Sure. Well, one day, Stephen, you will interview someone who tells you that they wanted to be a restructuring professional since the age of 10, but alas, today is not that day. I, like so many of the guests, fell into the field, really a product of my time. I remember my first day as a trainee, which was the 29th of August 2007. So we were the eve of the GFC, really. And I was trying to log into my computer, literally fresh off the boat first day. And my supervisor said, "Zip, do you know what a sieve is?" And I thought, what a strange question. Yes, it's a baking implement that removes lumps.
Absolutely.
And he said, no, it's a structured investment vehicle, and one managed by Cheney Capital with a face value of over $7 billion went into default yesterday. And we have just been hired to advise the trustee. Don't worry about your password, get a pen and a paper. The clients are upstairs, off we go. So that was quite the baptism of fire. I was right place, right time for the first time in my career. And I had sort of a 12 to 18 month stint as a linchpin trainee on that restructuring. Mm-hmm. The Cheney Civ had about 50% of its assets in RMBS. And so when the subprime mortgage crash happened, its whole fund value, the fund value fell to less than 50% of the paid-in capital. And that was the definition of an enforcement event. And so that started this process. Deloitte were appointed as receivers, and we worked with the trustee on behalf of the creditors, which was quite frankly a mess, and people actually didn't know what to do at that time. Andrew Wilkinson, who I think was one of your first guests on the Turnaround podcast, was at Goldman Sachs, and he and his team proposed and underwrote and executed a very creative restructuring. So this was now 2008, using a vertical strip process. So instead of just dumping all these assets into the market, which would have really got fire sale prices, Lehman's was going, it was really not a good time to be selling assets. The vehicle was restructured into a new SPV, which issued notes, and investors via an auction, bid for these vertical strips. So it had some of the good bits, some of the medium bits, and some of the rubbish assets in those strips. And that better spread the assets and sort of led to truer price discovery in what was a very difficult market. And that restructuring was implemented in the context of an insolvency framework. So for me, that was just absolutely fascinating as a little trainee. Having had my first taster then of restructuring, so I signed up for more and I joined, as you said, James Room's team at Bingham. And again, right place, right time. That the team at the time was a prominent force in the European restructuring market, advising bondholders on complex cross-border transactions. And I spent a very happy 8 years there. My first transaction as a newly qualified was Wind Hellas, so a Greek mobile operator with a Luxembourg issuer, Egyptian sponsor, the victim of the financial crisis and approaching insolvency. And we did a very whole-scale restructuring, which involved a COMI shift. COMI shift to the UK, English administration and English scheme. For me, it was a fantastic case study. I saw all of those processes, a chapter 15 to boot. But the most striking element was really when I understood, hang on, this is actually a global chessboard. This is even more exciting than I thought. Companies can move, they can avail themselves of different processes. And I just thought, wow, this is a fantastic place to be.
Sorry, I should say for the audience, COMI shift means centre of main interest. And obviously you start running a company from the UK. And I recall at the time a number of commentators outside of the UK saying this is a disgrace. London is the bankruptcy brothel.
That was it. That was the quote, Stephen. That it was controversial at the time. But I found it just fascinating. And so I did 8 years there in a very close-knit team. During that process, Bingham became Aiken. And I knew that restructuring was my field, principally, I think, for 3 reasons. It was difficult, it was interesting, and it was important. So difficult, no restructuring is easy. It's a high effort endeavor. We've got a pressure cooker of competing interests. There is time pressure. Characters come out, and I actually loved that chase. I liked the adrenaline pumping, and I sort of thrived on the pressure. No offense to M&A lawyers, but we don't have just a seller, a buyer, and a target in our world. We have banks, senior secured, senior unsecured, maybe some MES, issuers, sponsor, trustee, security agent, might have a credit insurer, HMRC, pension trustees. I've run out of fingers. There are so many stakeholders in our play, so many stakeholders. And to boot, the first 4 I listed, they can change during the course of your transaction. So if it wasn't hard enough, you're dealing with a liquid asset and clients that can, change. So I love that difficulty. Interesting. Well, no 2 restructurings are the same. And the type of work that I was doing required creativity because they were difficult and they hadn't been done before. So each mandate is idiosyncratic, maybe for reason of the company, the stakeholders, the jurisdictions involved, but very, very interesting scenarios. And it's important. If you don't restructure companies, then they can go insolvent. Jobs will be lost, R&D will be stopped. And ultimately, what we do saves companies, saves the companies that can be saved, and that contributes to the economy.
Well, that's exactly how I feel about the industry. So you've said it in a very interesting way, and I guess that time at Bingham McCutcheon was interesting because I think talking about different stakeholders, they tended to focus, and Aiken presumably still focuses on bondholders, and I guess that's an interesting constituent because they're changing all the time. So you'll start off with one set of bondholders, and they may trade, and it becomes a different set of people. How did you find that challenge?
I mean, I really enjoyed it. I think part of being an advisor is to corral the masses, particularly when you're dealing with ad hoc bondholders. And I had some really good people to learn from. Speaking to a par investor and speaking to a distressed investor are 2 different conversations, and they require different advice. So that transition, which we often saw from par to distressed players, I was working with experts and I learned a lot from them.
Yes. Can we talk a little about your transition from private practice to in-house, which obviously does happen quite a lot, but it's interesting to know how you sort of worked as what the differences between the two were, and how you found that transition.
Sure. So after 8 years at Aiken, I transitioned to Warwick. I was their first lawyer and I sit in their investment team. I'm the only member of the investment team with a legal background. Mm-hmm. It took me about a year probably to transition and to shift my mindset, and I still miss having my own office, but there are benefits of open plan and being on the desk and hearing what's going on. If I had to describe why I like being in-house, it's because my perspective has changed, and I'm going to use a photography analogy. What one does is one zooms out, and when you zoom out, you become further away from your subject. So if the subject was a document, let's say, I am further away from the drafting of that document. Yeah. But what I get is a wider frame. So I have more perspective. I understand a lot more holistically about what this investment is, rather than just being a specialist in that one restructuring agreement. At Aiken, we would do a debt for equity swap and we would do the restructuring agreements. But by the time it's becoming equity term negotiations, that goes over to corporate. And so you really are, you're quite focused. I'm the opposite of focused here. I deal with anything that happens in the investment sphere at Warwick. So although I miss sometimes being in control of every and every or in every clause, and I had a lot of pride in my drafting, so I do miss being in control of the words. I appreciate the wider frame and the perspective of actually this is one deal as part of a diversified portfolio in a fund, which is one fund of a number of funds in a global strategy. That is a privilege to see.
Stepping out a little bit, because we started off with you talking about SIVs, structured investment vehicles, and it strikes me that often it must be quite difficult to describe what you do to people outside of your immediate sort of. So how would you describe what you do to somebody you've sat down to dinner with?
Sure. So I think I'd say I'm a partner in the investment team of a special situations fund, and I have a legal background. I have significant experience restructuring companies, but I'm using my skill set with an investor or sponsor mindset now. I am quite puzzled, to be honest with you, by distressed debt or special sits funds that don't have a lawyer on their desk, a dedicated restructuring lawyer on their desk. We have become more common as time goes by, but there are still some that don't. And I don't really understand it because, to my mind, legal considerations and factors are integral to investing in special sits and distressed debt at every point in the cycle. At entry, legal diligence is critical because you are buying an instrument and you have to read the rights and obligations of that. During the hold period, obviously, sometimes a strategy involves an implementation process. You need to understand it. It's often legal, and at exit. So the thought of, and you can obviously use external lawyers, as many firms do, but they will invariably have an agenda, and I don't understand why you wouldn't just have someone looking after only your interests on your desk real time with that wider perspective, so they understand where you're coming from and then can tailor that advice to you. If I give you an example, something that might come across my desk is a question of whether to litigate or settle something in one of our portfolio companies. And so one can obviously go and get advice on the merits, one can go and get advice on enforcement, damages analysis, etc. You can price up how long it will take to litigate, how long it will take, etc. And that may give you the answer to the question, is this best litigated or settled? But that isn't often the right question, or it isn't the complete question. It's actually what we want to know is what's in the best interests of an investor in that fund. That is the question. And perhaps for them, a sale in the next 12 months will generate the best return. And perhaps litigation, material litigation, which may need to be disclosed, which may distract management, which may trigger cross defaults or material notifications, etc., that may not be in the best interest of the ultimate, who we're all here trying to serve, which is the investor. So me having the benefit of that wider frame, I can input into that decision and advise my colleagues better than a litigator in a law firm who doesn't have that knowledge and quite frankly has an agenda because ultimately they want the work.
Yes, I mean, I'm shocked that you would think that lawyers would want to continue litigation in those circumstances. But yes, I can see why your cynicism and the fact that you're totally oriented towards what's in it for the fund is the most important thing. And a little bit of talking my own book. I mean, occasionally I do come in these exactly the kind of situation where perhaps there isn't a generalist or a special counsel like yourself on working with a fund. I do work very separately where there's a big set of other lawyers around who may have their own self-interest, which is understandable. Can we move on a little bit, because I noticed a few weeks ago, and one of the reasons I was so keen to talk to you is that you did a LinkedIn post where you mentioned you frequently find yourself the only female in a room of males in a professional situation. So I guess, I mean, that really intrigued me because I think it resonated, but I wanted to ask, why is that the case? Why are there so few women operating in the industry? It's clearly not, on the academic side, actually, the data seems to be suggesting more and more women are going to university. In fact, they're outshining men. So why in this part of the industry do you find yourself the only woman in a room full of men?
Yeah, it's a really big question, and it's, to be honest, not one that comes up much in these types of fora. And I think that's because men feel underqualified or perhaps embarrassed talking about it, and women are hesitant for one of three reasons. Firstly, if you are surviving or thriving in a male-dominated world, you don't want to be seen to be whinging about that. You want to be seen to be head down, doing the work, and not with any chips on shoulders. So that whole perception of whinging, people don't want to do. The second reason is when you start talking about it, it's very hard to stop, because when you do say, I'm happy talking about this subject, you get inundated with requests to come and speak at this conference and that conference, etc. Yeah. And actually, there's so much more to my career and my work than being a woman in a male-dominated industry. I don't want to just talk about that. And the third reason that people hesitate is because it is like venturing into a minefield voluntarily. Yeah. It is so easy to offend. I will do my best to give you my personal views on the subject, but I will probably offend someone inadvertently in so doing. It's emotive, it's personal, everyone comes from it from a different perspective. That said, it is an important question, and so we should give it time. It's a big question. So if we try and limit it, I think, and sort of peel the onion, because we have a multi-layered industry. Let's start on a positive. So law firms, legal advisors, and the bar. I think they've actually made huge progress. When I joined as a trainee, the 3 or 4, biggest restructuring teams were run by white men, and that has changed. And so there has been really good progress at partner level and very strong pipeline progress at getting senior women in restructuring teams. Next layer of the onion, financial advisors and IPs. It's a little bit more numerical, less word focused. Still, progress has been made. There are some fabulous women IPs out there, valuation experts. You have already interviewed some of them, but perhaps obviously not the numbers we would hope, but they are there. Next layer, buy side, distressed debt or special situations fund investment team, and I say that carefully because obviously there's BDI and IR is quite well represented, but if we put just look at the investment team, the numbers fall off a cliff. They really do. And that is what I think the nub of your question is. So that's what I should like try to answer. Before coming on to the reasons why that may be the case, I actually want to tackle the so what, because there will be some people listening to this who just say, what's the big deal? Does it matter? Why do we need women in this team? They're probably not very good at it. Why is this a valid topic of conversation? And sadly, I think some of those people are in very senior positions in some of the funds. And so why I think it is important is completely backed up by tons of empirical evidence and studies that have happened, which shows that diverse teams, and this is not a gender point, this is just diversity, generates broader perspectives, reduces groupthink, and leads to more balanced, informed decision making. And that is what we should be doing. Diverse teams, particularly with women on them, have better governance in them, stronger risk management, and a stronger culture. And all of that leads to stronger financial performance.
Mm.
If you think
Okay. Sorry to interrupt you. What do you think, accepting your premise there and thinking, well, what do we do to get more people in the industry? What do you have any sort of thoughtful, practical points that you'd like to see implemented?
Yeah, so I think the causes of the problem are probably pipeline and role models on both sides of it. We would typically hire from an investment bank or financial advisory space. There are just fewer women there. They might typically hire from engineering, economics, maths degrees. There are typically fewer women there. And if we go all the way back to school, there are fewer girls taking maths and STEM subjects. So that is a big pipeline problem. And even where we are in 2025, there are a lack of senior role models. So when you're embarking on a career, it is quite nice to have a look up that chain and see somebody that you can associate with. The second problem, I think, is perception. So people think that the culture is male dominated, aggressive, tough, risk-taking, etc. And the third reason is work culture, lifestyle concerns, which, to be honest, are relevant for any transactional sort of work stream. I do think there is some unconscious bias in hiring and promotion, and I think the more we talk about that, and the more we just try and look at our practices through that lens, it's a positive thing. So if I was talking to a male founder, who said, I haven't got any women in my team, or I've got one or two, how do I improve the scope for them? I would say, just watch your bias. So do you perhaps have a Thursday evening five-a-side football social? And does actually most of your investment team go to that, but this girl, let's say, doesn't come along to it? And then after that football thing, do you go to drinks? And actually, is that a really good social internal networking space, which it doesn't have to be a girl, it can be anyone, is not getting access to? And if that is the case, I'm not saying cancel your football, go ahead with your football, but just add another equivalent event that is sort of more equally accessed, that can sort of right-size that. I would also recognize difference in approaches. So if you have a weekly trading ideas meeting and it's the full team, you've got 20 people, most of them men in a room, and people are asked to submit ideas. And let's say you had a young associate and she came to you the next morning, she stayed quiet in the meeting, but the next morning knocked on your door and said, I had this idea and it was a great idea. Her idea is not worse because she just came to you quietly and told you one-on-one because she didn't want to share it in that big forum. In fact, if it's a good idea, it's a good idea. So next time you have that meeting, you give her that credibility and you say, well, she came to you with a great idea, let's discuss it. So that sort of male allyship, just recognizing that people do things differently, I think.
Mm-hmm. Got it. Well, it feels to me like we could spend the whole time on this, but actually I'd also like to sort of ask more specific questions about the fund. Can you just outline Warwick's strategy and like, what is it? Is it a private equity fund? Is it a hedge fund? Like, what is the structure and what does it invest in?
Sure. So it's a global manager, but it has deep roots in European special situations. If you look at the investment team, all of our backgrounds come from restructuring. So whilst we're experts in no particular industry, we are experts in financial restructurings. And over the time, it's been around for a long time, relatively, so over 15 years. And over time, it's expanded to build out teams in compelling strategies, niche strategies that don't sort of neatly fit within the flagship structure, but were compelling enough. And so That's why on the website you may see specialty products. There might be some royalties and mineral funds or carbon solutions or litigation finance, etc. But the common thread amongst all strategies is we're trying to find companies or businesses that offer outsized returns. And I think we should focus on the flagship strategy today, which is special situations. Special situations is a gloriously vague term. So I think everybody has their own understanding of what that is. To me, it is an out of the ordinary event or circumstances that create a temporary opportunity where a company is undervalued or mispriced. And that leads to an opportunity for certain investors to create value and higher than usual returns. So that to me is the situation. Now, markets tend to be relatively efficient. So to get this mispricing of risk and return, you need a special situation, something out of the ordinary. And you also need a specific skill set that can unlock that value. There's many reasons where that special situation could arise. Perhaps there's market dislocation, perhaps there's just stress and distress in the market. Perhaps it's just really complicated and people don't get the business. Maybe there's been a change in market sentiment, a change in the regulatory landscape, an issue with their governance, an operational problem, an inefficient or outdated capital structure. All of these things are the types of special situations which create opportunity for us. My colleague uses the term 20% return for treasury risk, and he uses it a lot. I understand it's actually very good at getting the gist of what we do. 20% return, so an equity-like return, but for treasury style risk for minimal risk. And I do appreciate I'm inviting a heckle now about treasury risk in 2025. I actually preempt it. So by their very nature, we want complicated situations because ultimately that means there's likely to be less competition and we can get a better price to get involved at those complicated situations. To that, we add our deep restructuring experience that we've amassed and legal and financial analysis, and then try and negotiate a deal that really delivers downside protection, but upside returns. I think to bring that to life, because I'm conscious that was quite a lot of blurb, but to bring that to life, I should probably give you some examples. So I can talk through the three main types of special situation that we look at. One is dislocation. So this is short duration, high IRR. There's been a shock, there's been an issue, and we think it will rectify relatively quickly, but there's an opportunity to be taken. If you think about lockdown and COVID and the restrictions on travel, that meant that the supply demand dynamic on aircraft meant that you could get some really good deals, and the market dislocation was there to take advantage of if you had capital and you could acquire these aircrafts at very good prices. Then there was rectification, and obviously the idea is you sell them, making it a good profit. So that's an example of a market dislocation. Undercapitalized sectors. So these are sectors where there's a scarcity of capital from broader market participants. That may be because of sentiment or because of structural inefficiencies, or again, just pure complexity. These are not quick fixes, so they are longer term solutions that require a lot of our time and effort, but they are sort of steady build strategies. I'll give you an example. When retail banks sort of retreated from the SME lending space, that provided an opportunity which we took for challenger banks to fill that gap. 7 or years ago or so, litigation funding was extremely nascent, and we invested there to set up a platform to take advantage of that because more traditional lenders were less comfortable sort of diligencing that asset. So another way of putting it, maybe the area wasn't very sexy at the time, but that doesn't matter. We don't need that. And then the third is classic mid-market good company, bad balance sheet, which I'm sure is a term you've heard lots. And essentially, these are fundamentally solid companies, but for some reason, they are encountering a financial or an operational challenge. And that can be solved by either turnaround capital and restructuring skill set, both of which we provide. An example of that might be a European industrial company that we acquired. It had expanded into the US. It had levered up, and that hadn't gone so well for it. It had dragged the European business into a pre-insolvency process. It's quite complicated. And we stepped in and acquired the majority of the equity, but also took out one bank, provided working capital facility. There was a lot going on. It was listed entities, quite a few jurisdictions, and very, very complicated. And quite frankly, it would have just put off a lot of investors. But for us, that was a fabulous opportunity to showcase what we could do.
Yes. What I get from this is you're pretty agnostic as to the type of instrument that you use. So you might do some debt, some warrants, some equity, and flexibility is the key. I think my sense is that often where you're doing the stuff that no one else will do, essentially. So you have lots of people who might do on the run stuff that is part of an auction, and there's a process and they're geared up for it. Whereas you will do things very, very quickly in complex deals, etc. Where do you find these situations?
Yeah, fair question. And we typically don't like competitive processes where you're in on a distribution list somewhere. So we take a thematic approach to origination and sourcing. So as a team, we will discuss market themes and where we think these sources and pockets of special situations will arise. And then sort of in that internal shortlist, that will help guide our outreach to our network. And really, it's just the fact that we've been around for quite a long time and have good and diverse and complementary networks of contacts that we use. And it's quite organic, and it's all quite natural, actually.
Yeah. And often, actually, it probably comes through people like me. Often I'm in a situation and I'm thinking, oh, God, this company definitely needs some money. Who do I call? It's as sort of simple as that. And I'm actually so curious because we've obviously had a massive idiosyncratic shock in the general market, which are these tariffs and very high tariffs on China. Do you see that? Are you beginning to see that as an opportunity set, or is just that not becoming apparent yet?
I think beginning is the key word, because I think there's just an incompleteness of information. I don't think anybody can say that they have a full picture at this stage, and it's a moving feast and it's an unpredictable scenario. So I think how I would describe the current investment climate as one that requires a great deal of caution and a great deal of thought, but one that probably will offer good opportunities for those who are selective and thoughtful in their approach, have rigorous screening, etc. Caution and opportunity.
Yeah, I guess this sort of brings to the next question, which is geographically, obviously some of those opportunities are going to be in America, but actually some may be all over the world because, this is affecting everyone. Do you have a geographic bias? Do you have a sort of industry bias? What the approach?
Yeah, we're focused on Europe. So we are primarily focused on Europe. The fund has carve-outs for rest of world, but we want to do deals in Europe. And to be honest, there's a lot of deals in the UK right now, so we don't need to travel that far.
Yes. Yeah. Okay. So, we talked a little bit about this, but in terms of your current view on the European investment landscape and the special sits landscape, is it going to be an interesting one over the next 12 to 18 months?
I hope so. I think so. We are seeing rising levels of default, not crazily so, I've been saying it for a long time, but there are rising levels of default, and there's still an overhang of cov-like sort of loans. Macro conditions are just creating these fracture lines, higher for longer interest rates, slowing global growth, tightening credit markets, and they will have an effect. And we've also got very proactive liability management coming principally from the US, but a new era of companies really aggressively pushing out maturities, managing liquidity, etc., and potentially triggering sort of legal disputes and issues in so doing. But it is a changing landscape. but also the industry is changing. So the big players are becoming vast. There's a huge amount of consolidation in asset managers, and I think people refer to it as the scale game. And for these mega managers who are sort of one-stop shops now, for them to move the needle, they need to be doing really large deals. They've got to be putting to work more than $100 million a time. And I think what we notice is that has created a little bit of space in the more sort of mid-market space, which is where we operate, and that is positive.
What is a mid-market investment for you?
I think anything under 100 million would be the space that we look at.
Right, because I suppose one of the things that I see a lot of is actually quite small, a need for small opportunity, like 5 million or something like that. Would you go that low, or is that too low for you?
That's too low given really just the proportionality of the resources that we've got. And so we need to make sure that we're putting to work enough money for it to be worth dedicating the resources. So we would look at sort of 15 plus, 15, 20 plus.
Right, yeah. And are there many competitors out there? I mean, when these things are shown to you, is it sort of shown to 20 other funds, or actually is it a fairly small select group?
I think it is. I think it is more selective than you might think. I think there are sort of 5 to 10 players in our space. Where we differentiate ourselves is we are focused. We aren't trying to do everything. We are focused and we are experienced. And so I think there aren't actually that many that have the length of time that we have in the market and just establishment.
And is it a style investing that you see is growing, or do you actually? I guess what I'm really saying is that are we seeing sort of more funds that are, well, I'm just equity or I'm just debt. This is a very complex thing. I can make money doing, more simple things, or do you actually think it's a style investment that's going to stay, and there's a real need for it, and you can make lots of money doing it?
I think the latter. I think there is clearly a need for people who have this experience and have the capital and can put money to work, carefully structured, downside protection, upside risk. There is clearly a market for that, and I don't think it's going away anywhere.
Yes, and I guess the other question is: are we also seeing, or have we seen, really through regulatory reasons, banks retreating from that sector, and this sector being pretty much a funds only thing, or do you find that banks are happy to still get involved?
So I think that's absolutely right. I think there has been a retreat off the traditional banks in the sort of situations that we look at, and that does indeed create space and opportunity for funds like us. Yeah.
And I guess my final question on this is: do you have a sort of a particular specific deal that you can talk about, which you're sort of particularly proud of that happened in the recent past, that you think, that was something that was a really good thing, and I'm so glad we got involved?
Yeah, I would probably say that for me, one of the most satisfying deals was the industrials I mentioned earlier. So because it was just very complicated. I mean, we did so many legal procedures, and they were all connected, and it was one that ticked all of my original boxes. It was really an interesting sector where I could see the problem. We could see what had happened. It was a family-owned entity, and it had just gone slightly wrong. It was difficult, without a doubt, and it was important because ultimately we maintained and saved a lot of jobs, and so that would be my one.
Did the family stay involved, or did they? Right. So that's I guess that's another great marketing thing to sort of be able to say, we're not sort of rip your face off. We're taking everything merchants. We will work with you.
100%, providing a capital solution to a problem that you cannot fix yourselves. Absolutely.
Yeah. Great. Well, I think we're coming to the end. Is there anything I should have asked you that I haven't asked you? Some burning thing that you meant to bring out in this discussion?
No, I think you've covered everything well, Stephen.
Fantastic. Well, look, I really, I think you've been such an entertaining guest. I'm sure actually your sort of DMs, as it were, and your emails are going to be full of people asking you various questions. So fantastic career so far. I'm sure it's going to be equally interesting as it goes forward, and we really appreciate having you on as a guest. Thank you very much.
Thank you.
Thanks.
Bye-bye.
You've been tuning in to the Turnaround podcast with your host, Stephen Phillips. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, frilibertas.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.